Good evening, everyone, and thank you to everyone who's here joining us today. My name is Lisa Partida with Homemaking LA, and tonight we have Tom Fuentes with Bank of California, and tonight's topic is going to be buying a home. So I'll go ahead and pass it along to Tom.
Thanks, Lisa. So tonight we have buying a home. We're going to discuss how to get ready to buy a home and figure out what you can afford in the first section. So we'll go ahead and start that. I believe tonight we have three sections. Two. I think there's two, but the sections are pretty long. So the key takeaway in section one, buying a home is very much a process. So you have to start by making sure you're ready to buy and figure out what you can afford first. So there's going to be several different reasons why you want to purchase a home. Some of the reasons can be you want equity, for example. Purchasing a home allows you to build equity in the home. Another reason why you might want to buy a home is to get out of a current rental agreement that you may have. Buying homes certainly still is the American dream and can help a lot in terms of security for your family, financial security too. But yeah, let's talk about equity. So you absolutely can build wealth in your home. Building wealth in a home comes from the equity that builds up from owning the home. The equity generally equals the market value of the home minus what you owe for your mortgage, for instance. The current market value of your home is the price you would get if you sold your home today. The market value of your home is not guaranteed to increase, but it could. When the value goes up, it's known as appreciation. When the value goes down, it's known as depreciation. The amount of equity that you have in your home also can vary generally because of the changes in market value. Think about the market right now. The market still is up and is kind of ticking. It's kind of staying flat a little bit, but it's been up for so long. Houses are so unaffordable right now. It's wild. Let's talk about market value. What are some factors that may affect the market value of your home? Some of the factors could be, what are the prices of the homes in your area? The demand for houses. Do you remember during the COVID pandemic when I remember housing prices shot up dramatically? I was absolutely shocked. I mean, the values went up and they continue to go up. Updates on remodeling may increase market value. Maybe a lot of homes in your neighborhood are being remodeled. Many people see owning a home as an investment too. Maybe some people in the neighborhood are buying homes for an investment opportunity, and they're remodeling and fixing them up to resell. All factors of what can increase market value. So we talked about buying a home as being a process, right? So there's several steps to buying. Let's talk about getting ready first. So you need to decide, when is a good time? When are you ready? You can always reevaluate the decision later on in the process. But the main thing to figure out in your getting ready process is trying to figure out how much you can afford to buy. Will it save you time and trouble down the road to have a good sense of what the price range is that you're able to look into? Another thing as far as that price range too is consider looking at your credit score first. Pull that credit report, see what you're dealing with. Go to annualcreditreport.com and see how that fits into your situation. Also, let's talk about figuring out financing. You need to learn about mortgages and different financing options. Shop around. There's a lot of websites out there that'll cross compare with different mortgage products. That'll allow you to get pre-qualified and pre-approved, which is what you're going to need to buy that house. So you also need to shop for the home, putting together your team, identify and consult professionals that can help you with the journey, with the financing part, but also the real estate agent part too. We'll get into that a little bit later. Find out what fits your needs and what you can afford. Um, Step four, buying your home. Make an offer on the home that you feel fits your needs and that you can afford. Negotiate with the seller. Consider getting a home inspection. And then finally, you'll close escrow. And then we move into the maintenance of the home. You worked hard to get it. You need to do everything necessary to protect your investment. So making sure that you're up with home maintenance and repairs is going to be something that you're going to want to do too. Now, our workshops have sections in the participant guide that will allow you to learn a little bit more about the key terms that we talked about. We won't go over them tonight, but in this scenario, it's Hayden and trying to figure out whether or not now is a good time for him to buy. You can go through this section and fill out in the participant guide, which will talk about whether or not he has reliable sources of income, how regularly he gets paid, what's his credit history, so on and so forth. And then you can use his situation to parallel your situation. So how much can I afford? Only you know, only you can decide. So it's really a big question and it's up to you. When it comes to what is affordable, you're the only one that can make the decision, right? So you can get advice. There's guidelines that can help you decide what is affordable. You can come up with a spending and savings plan, figuring out what you have left for housing costs after you've paid for everything else. You also have to consider a debt to income ratio. This is figuring out how much of your income would go to covering the monthly debt payments, and it includes the monthly payment of the home loan. So two considerations. So only one way to figure out what is affordable for you is to start with the spending and savings plan by looking at how you spend your money now. By looking at how you spend the money now, you can figure out how much you can afford to pay for the home. You have to keep in mind, if you estimate what you should be able to afford, you may want to spend that much on housing costs. Again, only you can decide what you're ultimately comfortable with. To use the method that you see, you're going to take the total net monthly income and subtract your total monthly non-housing expenses, meaning expenses other than what you currently pay for housing. And the result is how much you have left over for all of your costs related to housing. So at this point, you'll come to an understanding of whether or not you have to increase your income, decrease your expenses, or eliminate some of the expenses to make the housing costs affordable to you. A mortgage is a home loan. You pay back the home with monthly mortgage payments. Your monthly mortgage payments are probably going to be the biggest part of the housing costs. When you buy a home, your monthly mortgage payment generally has 4 parts, commonly referred to as PITI. P is principal. It's the amount of money that you owe. Interest is the interest that you owe on that principal. T is for taxes and represents the real estate taxes that you're going to be responsible for. And I is insurance, which is representative of homeowners insurance. There are also other costs that you may want to think about. Some of these costs are one-time or occasional costs. Some can be ongoing. There's things like structural changes to your home that you may need to do, purchases of appliances, furniture, fixtures, decor, moving expenses, things like that, which are kind of like an added cost that we sometimes can forget about. And again, here's an example of something in the participant guide that you can use to determine what you can afford. In this scenario, we use what we learned about the My Spending and Savings Plan to estimate this. You can do it after the workshop. Let's talk about debt to income ratio really quick. The debt to income ratio is another tool you can use to estimate whether you can afford to borrow money. Your debt to income ratio is a calculation. The formula for the debt to income ratio is the total monthly debt payments divided by the monthly gross income that you have. The debt to income ratio is often written as a percentage. It shows how much of your monthly gross income, your income before taxes and other deductions are taken out, that goes to covering your monthly debt payments. Your monthly debt payments include your payments on any credit card balances you have, your payments on other loans, car loans, personal loans, student loans, so on and so forth. When lenders look at your debt to income ratio, they may have their own way of calculating it as well. For example, some lenders treat student loans differently than other loans. It just is dependent upon what the lender is going after. So if your debt to income ratio is 40%, that means 60% of your gross income is available to cover everything else. So there's other expenses besides debt. Think about things that can contribute to a higher debt to income ratio. We're talking about things like your food cost, household supplies, gas and electricity, basically any utility bill, right? Your cell phone bill, internet, whether or not you have car insurance, car payment, and then don't forget about the money that you're putting away in savings every month too. All things that will influence your debt to income ratio. One quick thing on the debt to income ratio specifically, you kind of want to be between 30 and 40% within that ratio. That's kind of what financial advisors recommend because there's still so many other costs associated with the monthly expenses that you're going to have. You don't want more than 30 to 40% of your gross income going to your housing costs. And here we go, and using an example here to calculate a debt to income ratio in the participant guide. This is going to show you the monthly gross income and the costs associated with determining the debt to income ratio. Go ahead and do this calculation in the participant guide after the workshop. You'll see by going through the calculation in the participant guide that with this scenario, you're going to end up having a debt to income ratio being just under 55%. And that's going to be calculated using the monthly gross income with the monthly debt payments associated to the scenario. So then we would kind of ask in this scenario, can this person afford to buy a home? I would say probably not. They're a little bit over the ratio. We really don't want you spending more than 60%. Excuse me, between 30 and 40% is acceptable. But it's all going to be dependent upon your situation, really. And this is how you can apply the debt to income ratio in this specific situation where they talk about going through the monthly debt payments and calculating the debt to income ratio. So this will bring us to the close and understanding the steps to buying a home and understanding that buying a home is a process. We went over those steps. We talked about debt to income ratio. To name a few things, we talked about the need for financing, which we're actually going to get into with, I believe this may be our last section, but it's a little lengthy. Let's talk about what it takes to finance a home, identify different types of loans, define loan terms and concepts, describe a little bit about how mortgages work, and then how to shop around for a mortgage. The key takeaway, know your loan, learn about your financing options for buying a home and shop around to get the best deal that's right for your needs. So for most people, buying a home requires a loan. Home loans, also called mortgages, are often the largest amount of money that you're ever going to borrow. Depending on the kind of house you're buying, there's going to be different types. Manufactured housing or mobile homes are on rented land. Therefore, it doesn't have a permanent foundation. So this will generally be financed through personal property. Loans to purchase a unit in a co-op for example, would be for a co-op loan. A house, condominium, or a town home would be financed through a conventional mortgage. Let's talk a little bit more specific about these. A mortgage is a loan that you use to buy a house, condominium, or a townhouse. The amount of money that you borrow is called the principal. Some of the many costs associated with taking out a mortgage also include interest. Interest is the money that the lender charges you to borrow the money, and it's represented as a percentage. There's also things known as points. Points are a trade-off between upfront cost and the monthly payment of your mortgage. By paying points, you pay more money up front, but you receive a lower interest rate on the back end. 1 point costs 1% of your mortgage amount, or $1,000 for every 100,000. So for example, if you're taking out a $200,000 mortgage, the loan offer may require you to pay 2 points or $4,000 to receive a lower interest rate than you would pay without paying the points. And in this scenario, 200,000 times 2% equals 4,000, and that's how you end up getting to the points. Besides points, there's also fees associated. These can include lender charges for processing your application. They may have different names such as application fees, processing fees, or underwriting fees. Other charges could be for an appraisal fee. Lenders will also tell you the annual percentage rate, or APR, for a mortgage you're considering. The APR represents the overall cost of the loan on an annual basis. The APR includes not only the interest rate, but also the points and some of the fees that were charged associated to you taking out the mortgage or the loan. Yeah. Let's talk about down payment. So the down payment is the portion of the purchase price of the home that you pay in cash. For example, if you wanted to buy a home for $160,000 and paid $8,000 for a down payment, you would borrow $152,000. That's $160,000 minus 8. That would be a 5% down payment. 8,000 divided by 160,000 equals 0.05, represented as 5%. The higher your down payment, the less money you have to take out to borrow. If you put 20,000 down on the $160,000 home, you would only need to borrow 140,000. That would represent a 12.5% down payment in comparison. When your down payment is less than 20% of the purchase price, lenders may require you to pay private mortgage insurance, represented as PMI. PMI lowers the risk to the lender of making the loan to you. Private mortgage insurance is different from homeowners insurance. Homeowners insurance pays for losses and damage to your property. PMI also increases your monthly payments, unfortunately. The lower your down payment as it relates to the purchase price of the house, the more likely you'll have to pay the PMI. The terms of your loan will specify how long you're required to pay PMI. Some loans require you to pay PMI until a certain percentage of your loan is paid off. And I would say, in my experience, that's mostly the case, that if you only put something like 5 to 10% down, once the loan to value ratio gets closer to that 20% that you would have put down, usually you can get rid of PMI. Another way that you can get rid of PMI is by refinancing your mortgage. In addition to the APR we already mentioned, there are other considerations. There's the loan amount. This is how much money the lender loans you. The type of interest rate. There are fixed interest rate and adjustable rate. A fixed rate does not change through the life of the loan, where an adjustable rate will change. We also have to consider the loan term. This is the length of the loan. You're probably accustomed to seeing loans with lengths between 30 and 15 years. That's pretty standard. There's also upfront costs that you may pay at closing. Closing is the last step when you buy your home. Closing is when the ownership of the property is transferred from the seller to you. Different lenders have different lending criteria, such as minimal acceptable credit scores. No matter the lender, the lower your credit score, even with the acceptable range, the more likely you are to pay for your mortgage. So we discussed a portion of PITI, let's talk about taxes and insurance really quick. There are two common ways to pay the real estate or property taxes and homeowners insurance premiums. As part of your monthly mortgage payment, that's one way, or you can pay them yourself. If you pay taxes and insurance as a part of your mortgage payment, your lender or mortgage servicer will add these to your monthly payment, and it goes into what's commonly referred to as an escrow or impound account. Then they will use those funds in the escrow account to pay off your tax and your insurance bills when they come due. Your property taxes and homeowner insurance premiums can change from year to year. Your escrow payment and with it, your total monthly payment will then also change. If the premiums are going up, sometimes your lender will give you a choice of paying the increase in a lump sum or spreading it over the payment period. Sometimes your lender may give you the choice of paying your taxes and insurance yourself outside of the escrow account. But more often than not, it'll come from the escrow account. So it's not as common. There's two types of mortgage loans based on how your interest is calculated. There's the fixed rate mortgage or the adjustable rate mortgage, commonly referred to as an ARM. A fixed rate mortgage is one in which the interest rate doesn't change. You pay the same amount each month in principal and interest for the life of the loan. Even if the interest rate rises, your payment doesn't change because your interest rate stays the same. Don't forget, even with a fixed rate mortgage, your monthly payment will likely increase if you have an escrow account for paying taxes and insurance premiums. The term of the fixed rate loan is often 15 to 30 years. The kind of mortgage may be a good choice if the interest rates are low or if you plan to keep the mortgage for a long time. What about adjustable rate mortgages? So ARMs, the interest rate adjusts according to the schedule or based on an index. ARMs may start with a lower interest rate than fixed rate mortgages, but your interest rate and therefore your monthly payments will likely change and go up a lot. The rate adjusts on the predetermined dates, for example, every year or every 3 years or 5 years. It just depends on your loan. This is often expressed in numbers such as 3-to-1 ARM, where the 3 stands for the number of years that the interest rate will stay the same, and the 1 indicates that the rate could change the year after the first 3 years. Ask the lender which index they're using and how it fluctuates. An adjustable rate mortgage may be a good choice if you plan to keep the mortgage for a short time. It may also be a good choice if you can afford to pay more if the interest rate increases and if you're unable to refinance into a lower rate. The opposite is also true. An ARM may not be a good choice if you cannot afford to pay more. Mortgage interest rates can change daily and sometimes hourly. A rate lock or lock-in on a mortgage loan means that the interest rate you're offered will not change during the time it takes to close on the home purchase, as long as you close within the specified time frame. So when you take out that mortgage, and if they agree to have a 5.5% interest rate, you'll lock that in for that set schedule of time. Rate lock periods are typically available between 30, 45, and 60 days, sometimes longer, just depends. If your rate is not locked, it can change before closing, unfortunately. A balloon payment is a higher than usual one-time payment at the end of a loan term. Some people may prefer a mortgage with a balloon payment because their monthly payment before the high balloon payments are lower. They may expect to sell their home and refinance their mortgage before they get to the balloon payment. This is risky though, because a balloon payment often will have a very, very large payment at the end of the loan. So make sure you understand the mortgage if you have a balloon payment before you get to that time. Conventional mortgages do not have special requirements for borrowers such as having served in the military or having rural community. They're available to anyone. You may generally need a credit history that is considered good by lenders, regular income, debt to income ratio that's not above 35%, a down payment which would be in the range typically between 3 and 20% or more, depending on whatever loan you're going to be taking out. There's also something known as a jumbo loan. A jumbo loan is a mortgage that is above a certain amount and tends to be for the purchase of a relatively expensive home. Think about high cost areas in San Francisco or New York, for example. You may also have heard the term second mortgage. Sometimes people can take out more than one loan to supply the financing they need to buy the home. There's also things that are known as government guaranteed loans, often represented as FHA, USDA, and VA. So the US Federal Housing Administration, the FHA, helps people become homeowners. The lender may be able to offer you better terms than on a conventional loan with an FHA. And FHA is a pretty cool option because you only have to put a down payment that's 3.5% of the purchase price of the home. Closing costs included in the loan amount, they're financed and not due as a lump sum at closing like conventional loans. So you get lower closing costs, which is cool. FHA loans may be easier to qualify for too. You may have to pay mortgage insurance. You may have to pay that PMI that we were talking about, because remember, the PMI kicks in if you don't put 20% more down. So that's a kind of a negative, but it could be useful. You just have to figure out what you can afford. You can find out more about FHA loans at HUD.gov. The US Department of Agriculture also has a program too. These loans are called USDA loans, and they're for rural development. And they're really designated only for rural areas. The nice thing about those, they're like the FHA where you only have to put down 3.5%. So that's pretty cool. More information on those is at usada.gov. If you're a military veteran too, you can get a loan through the VA. These loans are made available to active duty members of the military, veterans, reservists and National Guard members, and eligible surviving spouses of members of the military. VA loans are pretty cool too because they do not require down payments. You can choose to make one if you want, but you don't have to put one down if you don't want to, which is pretty cool. You can get more information on those at va.gov. Yeah, so those are pretty cool because you don't need to have a down payment. There's other forms of assistance too. You can get more on these types of programs at HUD.gov through the Housing and Urban Development website. Down payment assistance of closing cost programs can be used in conjunction with those FHA, VA, and USDA loans that we talked about. First-time homebuyer programs offer down payment assistance loans that can assist people with paying upfront mortgage costs. One of these things actually that I work with on a daily basis is through the Federal Home Loan Bank of San Francisco. The Federal Home Loan Bank of San Francisco has a first-time home buyer program called WISH, where right now in the program year, you can get up to $30,000 to assist in your down payment costs. One of the stipulations is you have to be a first-time home buyer, but it's pretty cool because it's a grant that you don't have to pay back. So yeah, there's really a lot of first-time homebuyer programs out there. There's some that are facilitated through mortgage lenders themselves, like Bank of America or Citibank, for example. There's also some associated with whatever city you're going to buy your home in. Santa Ana, for example, I know has a first-time homebuyer program if you're going to buy a house within the city limits of Santa Ana. There's also programs that are facilitated through nonprofit entities too. These often are going to be homebuyer HUD certified counseling agencies that help first-time homebuyers with financial literacy to buy their home. So there's lots of options out there. I would encourage you to go to Google and search for these. But down payment assistance is a wonderful program that you can use to help with closing cost assistance, with your down payment. Um, really cool programs out there. Yeah, so and then apply it for My Mortgage Options. This is going to talk about money for down payment, what percentage is required in the scenario. Feel free to look at it after the workshop. Let's go into the operation of actually like how a mortgage works. So there's 4 factors to consider that affect the amount of the monthly payment. Amount of the loan, the less you borrow, the less you have to pay back. The interest rate, higher the interest rate, more the loan costs. The kind of interest rate, is it fixed or adjustable? And then the term too. Is it 15? Is it 30 years? If you end up taking out a 15-year loan, your mortgage payments are going to be a lot higher because the length of the loan is shortened. Let's compare loans with different terms. With a 15-year loan, you'll have a higher monthly payment than the 30-year. You'll pay less in interest over the life of the loan, however. You'll be done paying off the loan a lot sooner. With a 30-year loan, you'll have a lower monthly payment because you're financing over a longer period of time. You'll pay more interest over the life of the loan, however. It'll take you longer to pay off, right? With both a 15-year and a 30-year, or any length of a loan for that matter, you can pay off your loan early by paying more money to principal, which is cool. So even if you took out a 30-year loan but wanted to pay your mortgage off at 15 years, just apply extra money a month to your principal and you can achieve that goal. And that's really cool because you're going to end up saving money over the length of the term because you're going to save money in the interest payments. So that's pretty cool. Another thing I'll take a note on with that, the way that mortgages are structured for you to pay a bulk of the interest up front. If you have when you're making your monthly payment, that is, initially for like the first 15 to 20 years of the loan, most of the money that you're paying is in interest. It's not until like the last 10 years of the loan that you're actually chipping away at that principal. So yeah, extra monthly payments are a pretty cool way to pay off your loan early too. So the amount of money that you pay each month is this word always gets me. Amortized. Amortization, hard word to say. So that means that the payment is calculated to ensure that you're paying a portion of both principal and interest each month. It also means that your payment will be the same each month, except for if the interest rate changes, of course, if you have an adjustable rate mortgage. The cool thing, and I implore you, if you're going to get a mortgage, look at the amortization schedule because you're going to end up seeing what I just explained a moment ago, where the interest is front loaded on the loan and the principal doesn't start going down into the end. There's a section in the participant guide up next here that you'll see. With this scenario for Lucia, you can go through to look at the amortization schedule to see what it looks like. I don't have an example here, but what it's going to have the payment due date, the beginning balance of the loan. It's going to have the scheduled payment due. It's going to have the interest rate, or excuse me, it's going to have the interest amount that's being paid to the loan, and then the ending balance. So check it out in the participant guide because you're going to see as the payments are made on a monthly basis, the loan being paid down until its conclusion at the end of the 30 years. So pretty cool. It really gives you a good perspective to understand how much the interest rate truly does affect the monthly payment. Talk about pre-qualification really quick. Pre-qualification is an informal way to get an estimate on how much you can borrow. You can get pre-qualified by giving the lender basic information like your employment information, your income information, down payment information, outstanding debts, and your social security number. No paperwork's typically required. There's no obligation. You just get pre-qualified. Most importantly, the pre-qualification is not you getting approved for the loan. It's not you taking out a loan. It's just getting pre-qualified to know how much you can afford, how much you can pay. So pre-approval, however, is a commitment from the lender to lend you money under some conditions they specify. The pre-approval process lets you know how much money you can borrow and tells sellers you're prepared to buy the home. To obtain pre-approval, you typically need your three most recent pay stubs, your W-2 for the last 2 years, your tax returns for the last 2 years, information about whether or not you have assets, information on your debts, recent bank statements, and any proof of additional income that comes in besides your from work. So very important to shop around. Know that so now that you have kind of like the understanding of the basics of a mortgage, you should be able to apply those principles and shop around. Get loan estimates from several different lenders. Loan estimates is a 3-page form that you receive after applying for mortgages. It gives you important details about the loan that you've requested. Your real estate agent may suggest at least one lender, but also get written estimates from at least 2 other lenders. Ask other real estate professionals, friends, colleagues, or family members for recommendations as well. If you have a relationship with a financial institution, don't forget to consider getting an estimate from them as well. So, for example, if you already have an account at Bank of America, they facilitate mortgages. It may be a good opportunity for you to go to your branch and find out more information. Contact lenders you are considering and tell them that you're ready to request a loan estimate. You don't need to provide written documentation yet. You generally just need to provide 6 key pieces of information: name, income, social security number, address of the home that you plan to purchase, an estimate of the home's value, and the loan amount that you're willing to borrow. There's no fee for a loan estimate, but the lender may charge you a credit report fee. There's also a worksheet in the participant guide that compares loan estimates. This is going to be comparing it across different loan types through conventional FHA, VA, and USDA. Feel free to take a look at that after the workshop. And I believe that this actually brings us to our conclusion, not only for section 2, but for the home buying workshop tonight. So the key takeaway from section 2 is knowing the ins and outs of your loan, learning about the different financing options that you have available to you based on what you can afford, and shopping around. And I implore you to shop around for anything financial related, whether it be a home, a car, a credit card. If you want to open a checking account somewhere, shopping around and comparing products is probably going to be your best bet anyway. Yeah, so that brings us to the end. Let me shut this down real quick here. What do you think, Lisa? Good
I love it.
information?
What was that?
Good.
Yeah, I was actually while you were talking about the equity and all that stuff, I started logging into mine just to see how much I paid off, and it's not bad. And I'm gonna start making extra payments because it does make a difference. I mean, even with $100, it could, I guess, kind of speed up at least 35 months.
Yeah, yeah.
Yeah.
Like I tend not to look at mine too much because I kind of get depressed because the payment is front loaded with
Hmm.
most of the interest. It feels that you don't chip away.
I know.
And I feel like my total loan balance just stays the same.
I hear you. Um, for some reason, I mean, I see it. It's only been what, a year for me, so it's not much,
Mhm.
but it's a little dent in comparison to the big
Right.
balance. But I think, like you said, just making those extra payments is really important. And maybe, whenever you have a couple extra $100, just throw it in there, because it is
Yeah.
your investment and you're kind of setting, it's going to be years eventually. I mean, it's
Right.
already years. But yeah,
Yeah, I agree.
yeah. All right. Well, thanks again, Tom. You have a wonderful evening and stay safe.
All right, you too. Thanks, Lisa. Have a
Thank
good night.
you too. Bye.
Bye.